Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, our guest for this week's show is real estate and hotel to resi conversion expert Ryan Sudek. Now, Ryan is the CEO of Sage Investment Group, a boutique real estate firm that focuses on addressing the affordable housing shortage by converting functionally obsolescent hotels into modern residential apartment homes. Now, during our discussion here today, Ryan's going to delve into the process of acquiring and converting hotels, including some of the challenges, along with the lessons that he's learned along the way of doing now more than 19 different projects. Additionally, I hope that we'll go into detail on the importance of the due diligence process, construction budgeting, and really engaging with the local municipalities to get these projects from beginning to the finish line. And so, with that, guys, I'm excited to welcome my guest for today's show, Ryan Sudek. Ryan, my friend, how you doing today?
Doing fantastic. It's great to be with you. Thanks so much for having me, Kevin.
Yeah, excited to have you here. Excited to talk about this topic. I can't tell you that I've ever been involved in a hotel to resi conversion. I think we've discussed it on numerous occasions, probably in the last couple of years in the show. But you've got quite a bit of experience. You've been doing it now since 2019, if that's correct. I think we just talked about, and you've done now 19 projects. So it's quite a good track record, I would say. I'm assuming that you've learned lessons in each and every one of them, but surely 19 is enough now to say that you've probably mastered most. Although we still, there's always skeletons in every deal that we do, right? But for the most part, 19, I would say that I could classify you, put you in the expert bucket. So with that, excited to dive into that here with you today. But before we do that, Ryan, before we go any deeper, I gave you the brief introduction. I know there's a little bit more to your background, and for those that aren't familiar with you, maybe take a few minutes, tell us a little more about yourself, and ultimately how you found your way into this niche.
Yeah, happy to. Well, you gave a fantastic introduction, so I'll keep it pretty brief. So Ryan Sudek, I grew up on the East Coast in New Jersey, ended up going to school out in California where I met my now wife. Post-college, graduating college, went into the corporate world, helped big companies buy smaller companies. So doing mergers and
Mhm.
acquisitions and corporate development, got to work with companies such as Samsung and Amazon, and Redfin, the real estate brokerage company, and spent, the better part of 5 years at Redfin, prior to joining Sage, where I ran, kind of all things partnerships, M&A, new business incubation, and then all of their digital revenue businesses as well. And, I'd spent some time, kind of on the tech side and real estate. At Redfin had seen, just the data on how acute the affordability crisis was in the United States. All the while, I had my corporate job, but in parallel, I had been, investing in multifamily value add deals and doing them myself. And that desire to get into real estate actually comes from my youth. So my dad was an airline pilot by trade, but he always had a small portfolio of residential real estate projects in our hometown. And on the weekends, I was swinging hammers with him, soldering pipes, installing toilets. And there's a very acute event, when I was young, that really solidified the value of having income producing real estate. And I love kind of the mission of what you're trying to do for your investors, because for me, what happened was, I saw my dad, who was a pilot, post 9/11, have his salary chopped in half, lose his pension, retirement. But we were able to kind of survive and continue to charge on because my parents had this portfolio of income
Mhm.
producing real estate. And I knew I wanted that insurance policy for my family one day. And so fast forward, I had saved some money, bought a sixplex, did a lot of the work myself, then an eightplex, then a 16 unit and a 30 unit, and kind of just did the Burr model, as it's now called, value add multifamily investing. That it got to the point where my day job was all consuming, and I decided to go passive as an LP. And so I actually moved two of my properties into Sage, which is now operating as a fund that I'm now the CEO of, and then just became a passive LP. And I joined Sage as CEO about a year and a half ago, last summer, to really help us, as we're going through a big growth, big growth phase, and really just building out the team and the infrastructure to help us execute more on the strategy to, take these, distressed hotels and convert them into vibrant communities that people want to live in.
Yeah, no, fantastic. I appreciate that background. And maybe we'll start Maybe we'll start with just I guess the basic foundation of when is the timing right to where a hotel is no longer the highest and best use? It's no longer lodging. It has a higher and best use of being converted to a residential project, residential apartment home.
Yeah, great question. It's usually when there's some distress.
Okay.
And so for us, we see distress in hotels come in a few different ways. It could be debt, right? Interest rates are up. It might be tough for folks to refinance or service that debt. Also, there's a lot of competition out there in the hotel space. It's not hard to go. I mean, I guess it's hard, but you can go build a new hotel down the street and you can take some of the business from the other hotels around you because you're the new shiny object. And you can have the support of a nice franchise like a Marriott or a Hilton or a Hyatt. And when that happens, the legacy hotels that were there, struggle to keep up their income. And, as a franchisee, which these hotels typically are, they have to keep up with the brand standards of the Marriotts of the world, who are going to ask them to upgrade the carpets, upgrade the kitchens, the countertops, et cetera, every so often. And it's hard when you've seen, either threats from down the street or just a reduction in overall travel like we have post-COVID. It's tough
Mhm.
for those hoteliers to come up with the CapEx and justify that investment. And so they might drop from a Marriott to a lesser tier, and it's kind of a slippery slope. And so, typically, we're there kind of waiting as they're, struggling maybe with that performance improvement CapEx, or, maybe they've gone independent, where we can, step in and, convert that asset, to your point, to its highest and best use. I'd say the third category of opportunities we see is just multi-generational ownership. There's a lot of Indian families who immigrated to the United States over the last few decades and bought these hotels. They educated their kids. Their kids are massively successful, and they're not interested in being in the hotel business. By some estimates, 60 to 70% of the hotels in the United States are owned by people with the last name Patel. And so we just see a lot of those families that have been very successful and are just looking to move on. And so, we buy from those folks. And what's great about those type of properties is they're well located. They're near where people work,
Mhm.
where folks who have good paying jobs but don't have affordable housing. And so, we can take these hotels that are struggling and convert them into those apartments.
Yeah, no, I appreciate that. I'm sure we've all have seen what you're speaking of. The new latest and greatest shiny hotel being built. In fact, a lot of times, if you all of us have traveled on an interstate, you always see the what was probably one of the primary original exits that had a couple of these now old legacy hotels. Now another exit down, maybe at some point in the last couple of decades. What was then the latest shiniest and greatest hotel, and then maybe even now further down there's three more exits. You've got the latest, right? You got the Bucky's there now. You got even another slew of brand new hotels, and it's like a slow death. It almost seems. Some of them are shut down. Some of them are still kind of just limping along. You could tell they haven't really put any capex dollars back into them. Most of them have broken up parking lots. Maybe even the gas station that was there, which was the primary gas station off the interstate, has shut down because there is a new Wawa or a new Pilot,
Mhm.
or you name the brand, right? That's a couple more exits up, the Bucky's of the world. It's so interesting to, I guess taking it to where you see the opportunity. Obviously, these are well located, well located assets. Just again, maybe not highest and best use is no longer that of lodging, or short term lodging. How do we identify the prospects? I mean, there's a lot of these, right? So like, there's. It's not just a hey, for every 100 hotels, there's one like this that is just falling on dire times. I mean,
Yeah,
it's quite a lot of them, I'm sure, and we've all
there
seen them,
are.
right? And so, how do you identify the best prospects out there for a conversion? I'm sure there's lots of considerations that go into it. The mechanical layout, just the overall floor plan itself. Location is obviously a big one, but just generally speaking, help us think through your process of identifying a winner and staying away from the losers.
Yeah. I'd say there's probably three things that we look at. The first is the market, the second is the layout of the building, and the third is just the feasibility of doing the project and working with
Mhm.
the local jurisdiction. So, in terms of locations that we like, we're looking for growing markets where wage growth and employment growth and population growth are strong, because that means that we're going to have a good supply of tenants for the property. For the property. And, when you think about the markets that we're in, I'm based in Washington State. We've got a good portion of our portfolio that's in Washington State, but we're also in the Carolinas, North Carolina, South Carolina. Colorado, Texas, Florida are some other markets that we're entering as well. So we're in 5 states today. We'll probably be in 8 states by the end of next year. And we estimate in those markets there's about 70,000 hotels that meet our building criteria. So
Hmm.
kind of the second set of criteria is, what we're looking for in the construction of the property, to your point. We're usually looking for between 100 and 200 units. We want at least 100 because then we can get the economies of scale, having on-site management that also improves the resident experience. But we don't want to go above 200 units. Otherwise, we have to start looking at taking what our individual studios and combining them, because we don't want to
Mhm.
oversaturate the market with too many studio units, because we're typically taking whatever layout that the hotel gives us and delivering that to the market. We do like properties with exterior corridors. It gives a feeling of, a bit more separation for our
Mhm.
residents. And on top of that, it also reduces our construction timeline dramatically. If you think about just even transporting materials, doing the trash out, bringing, materials to the front door, we don't have to go
Mhm.
up and down stairwells or elevator shafts. We can deliver it from the outside. That saves on construction costs quite a bit. A lot of these properties also have easily accessible, spine walls with the utilities in them that we can tap, because we are usually doing some heavy infrastructure upgrades, putting sub panels in the units, putting fire suppression in, making sure that the electrical capacity is high enough to support the kitchens that we add,
Mhm.
and just having an easily accessible spine wall to tap those utilities is good for us.
Okay.
And then
Uh,
the last thing that we do is just working with the local municipality to make sure that we can get a change of use from a commercial asset to a residential asset, and just understand what the jurisdiction is going to require of us from a permitting perspective. Are they going to try to levy impact fees against us? What energy code are they going to, help us adhere to? And we've got someone that's full time on our team that literally just focuses on that all day.
let's talk through that piece of it. I can imagine just dealing with municipalities, especially when it's just something out of the box, right? I mean, like
Yeah.
while they might have seen a few of these conversions take place, more than likely it hasn't been, probably more than one or two in their local jurisdiction, if any, right? And so like this
Right.
might be completely new to them. It's kind of like we're in the mobile home park world. Like it's you'd be better off just banging your head against the wall than to go talk about building a new mobile home community in a marketplace because they've already got these visions of what it's going to look like, right?
Yep.
It's going to be the wrong element, drug, sex, rock and roll, everything they don't want. That is not the case, but that's just how we get bucketed, unfortunately,
Mm.
because they haven't seen the other side of the spectrum that exists and the reality of it all. And so, talk to me about that piece of it and just the challenges and how you guys work through them.
Yeah. We fight a lot of misconceptions like you're describing. When we come into a new community, they might understand what the hotel has been or what it is today. And it could be
Mm-hmm.
crime ridden, it could be an eyesore. And we're coming in to get rid of that, right? We're
Yeah.
coming in to, deliver affordable housing and a vibrant, secure, thriving community. And so we lead with education. We try to get in touch with the city council members, with the folks in the planning and zoning departments. And we have, two folks that are really vital on our team. One is our director of community relations, and the other is our head of planning. And so they'll go in and they'll bring in the case studies if we're going to a new market. They'll bring in the case studies of what we've done in other markets. Take a place like Tacoma, Washington, where we've now purchased, 4 hotels on what's called Hosmer Street. Hosmer Street used to be responsible for 10% of all the murders in Washington State.
Wow.
And since we bought our first property on that street, we've now eliminated violent crime within a 2-mile radius. There hasn't been a violent crime. We've reduced overall crime by about 50%. The police used to send 3 officers when they'd respond to a call. Now they send one. And so we can take case studies like that and bring them to the new markets to help them see, what can be. And then from there, once we kind of win their support, and it's not hard to do, right? Like if we can lead with those case studies, everyone wants more naturally affordable housing.
Mhm.
And that's what we're doing. We're not usually asking for any subsidies. We haven't gotten any subsidies from governments, even though they exist. Then we can move to the practical of, okay, what are you going to require of us to meet the residential compliance? What is going to be the process for us to, allow for residential use in that property? And that's where, the rubber meets the road. And um, different jurisdictions apply the energy codes differently. Sometimes
Mhm.
they change their mind over time. And it's, every project is unique in that way.
How many projects that make it to this point in time actually die and don't go forward just due to complexities or just barriers that you're going to face with a municipality?
Yeah, it's a good question. It used to be a lot more, or a higher percentage. If I had to put a percentage on it now, I'd say probably 25% of the projects that get to a PSA, maybe even less
Mm.
than that, maybe 10% now. We're trying to do a lot of that diligence up front. And the
Mhm.
relationships that we have with our sellers, we want to be true to our word, and we close our deals unless there's a curveball thrown. I can think of one, actually two properties this year that we didn't purchase because the city wanted to levy, ten or $15,000 in impact fees per unit,
Wow.
for us to do the conversion. And so, I think it was just an honest conversation with the seller. Hey, we had certain assumptions coming in and we had to walk away from those. But yeah, I'd say it's probably about 10% right now of those that get under contract that end up, failing out for one reason or another. But we try to have a lengthy, closing process, usually about 6 months from when we get under contract to when we close. So we can have that change of use permit in hand. We can have plans ready to go and we can start construction on day one.
In that example you gave where they wanted ten to $15,000 per unit impact fees, is that just a short-sighted decision on their part, or is there more to it than that? Like an
Yeah.
underlying, just like, is there, they just want nothing there at all for whatever reason? I mean, I mean, like it definitely doesn't help their tax base if that hotel goes out of business
That's
and it
right.
becomes a vacant parcel. So like, again, is it just short-sighted, like just not really fully comprehending the benefits that really it's beneficial to everybody
It
involved?
is. It is. I think it's more just rigidity, right? There's a certain set of rules that exist that when you
Yeah.
build a new housing unit, these are the fees that you pay. And, sometimes that means that a 4,000 square foot single family home will pay the same amount in fees as, a 300 square foot studio unit that's being adaptively reused like we do. Which feels weird, right? Because our tenants are typically single, maybe a couple, certainly no kids. We're not having significant impact on schools, very little. We have amenities, so we're not really impacting the parks nearby. The infrastructure for utilities and sewer and water, it's already been tapped as a hotel. Arguably, our
Yeah.
tenants use less. I don't have the data on that, but we're
Right.
not washing sheets every night like the hotel is. And so I think it's really just there's a set of rules that exist, and the local municipality is used to following those rules, and so they can kind of fit us into a box even though we look a little different.
Yeah. No, that makes sense. So fair enough. So we'll chalk it up to be short-sighted.
Short-sighted works.
Yeah.
Yeah.
Yeah. Fair enough. Fair enough. So the layouts you'd mentioned, basically 100 units is kind of the preference, like the minimum standard.
Mhm.
Anything over 200, then you have to start looking at maybe combining. And so just, I guess, 100 to 200 units, you guys are pretty much using, it's one for one, like one hotel unit converted to one residential unit. You're never ultimately combining two units. So where if you bought a 200 unit property, it wouldn't, yield 100 residential units. Is that a fair statement?
That's a fair statement. It's
Okay.
really just the investor math, right? The investment returns.
Yeah.
To
Mhm.
combine two units into one, you take a studio and it'd become a one bedroom. You
Yeah.
usually can't charge double for a one
Double.
bedroom
Yeah.
than you would for a studio. And so it just, the economics of keeping them, as they are. Sometimes we're buying properties. We're buying three properties in Texas in a couple weeks. Some of them are already one bedrooms and two bedroom layouts just from,
Hmm.
having suite style hotel rooms. So
Hmm.
we'll keep those as they are, but typically not knocking walls down unless for some reason the city required it of us. But typically we find that the city is okay keeping the number of active hotel rooms and converting them into residential units.
Yeah. What's the demographic that you're typically serving? I know you mentioned no
Mhm.
kids, but like, average age group that you guys are servicing.
Yeah, I wouldn't say there's an average, there's maybe a couple different cohorts. So
Mhm.
generally speaking, our tenants are the folks who make too much that they don't qualify for government help, but not enough to afford the brand new Class A that's
Hmm.
being built down the street. Our units are usually $300 less per month for our tenants, but they're smaller. But
Hmm.
it comes with full amenity package of dog park, pickleball courts, et cetera. So what we find is we get a lot of older couples without kids, maybe with a dog, a pet, approaching that retirement age or past that retirement age. We see on the other end of the spectrum, we see folks who were living with family, want some independence going out on their own, military professionals, nurses, waiters, waitresses, folks who are living with roommates maybe before and wanting some of that independence. And they usually work really close to the communities in which we develop, like I was mentioning. These are typically in transit corridors. They're near centers of commerce. They're near
Mhm.
where our tenants are working.
Are you usually on a bus line, or do you find that most of your tenants have a vehicle?
Uh, it's our tenants typically don't have vehicles. I don't have the exact percentage off the top of my head, but we are
Mhm.
typically looking to be near our bus lines because we find that transportation is the second largest expense behind housing for our
Yeah.
tenants.
Yeah. And then the average cost to convert one of these units, I know that's a loaded question, but just trying to get a sense of where you guys need to be on a basis going in, what you're
Mhm.
ultimately putting into a unit to get it to your standard, and then what's like an all-in per unit cost look like? And because most of us that are tuning in here, we probably have some type of idea, at least as a standard multifamily, like a built purposely multifamily project, what that might cost to build today, what they might trade for in the open marketplace. Just trying to
Yeah.
compare one to another.
Typically, we're creating these units for about half of what it would take to build from the ground up.
Got it.
So to break it down into the acquisition costs and then the development costs, obviously it varies by market, but on the low end, we've paid as little as 20 or 25,000 a unit in a market
Mhm.
like Columbia, South Carolina. In a luxury market like Bellevue, Washington, we've paid over 100,000 per unit on the acquisition
Okay.
cost. Now, in Columbia, they'll probably rent for about $1,000. In Bellevue, they'll probably rent for about 1850. On the development side, obviously depends on what the property comes with. The properties in Texas that I was just referencing were renovated in 2012, 2015. They've already got sprinkler systems and sub panels in the units. So we'll only spend about 10 or $15,000 per unit on those. But more typically, we're having to make the infrastructure upgrades. We're having to do, we do heavy renovations so that these live like brand new communities. So we
Hmm.
spend between $37,000 and $50,000 per
Okay.
unit on the development costs, and that's where we have our secret sauce. We've, like you mentioned earlier in the conversation, we've done 19 of these. We've got contractors who know our process. We've been able to value engineer various line items within the scope of work. We're buying materials in bulk, and so that helps us keep our costs
Hmm.
significantly lower than our competition out there.
Yeah. No, I love it. I love it. Talk to me about financing.
Yeah.
Are these, well, I'm not going to, I'll just start, let's start there. Financing, I guess the first phase of the project, right?
Mhm.
Hotel to the conversion. How do you guys do that? And then when you're looking to do takeout financing, where does that go? Does it end up being agency, Fannie or Freddie, or is there an alternative method?
Yeah. So upfront, these properties are delivered to us vacant, so they're not producing any income, which means that we need to get some sort of a bridge or development loan.
Yep.
And there's really two categories of lenders that'll lend to us. One is the community banks, the credit unions, the local folks. And then on the other end of the spectrum, it's the debt funds of the world. The community banks and credit unions, we love working with them, but they do have exposure limits. There's only so much you can borrow from them, but they're going to give you a really great rate. Maybe the leverage will be a little less. And then on the debt fund side, leverage a little bit higher, but you're going to pay more for that interest rate costs, and you won't
Mhm.
have those exposure limits. So you'll be able to borrow a bit more. Recently, we got just to put some numbers on it, we got a $20 million bridge to perm note from a local bank here in the Northwest for 6.5%, which blew
Wow.
my socks off. It was awesome.
Yeah.
Wasn't we were underwriting that project to be spending about 11% on the interest, which is what we would normally pay from a debt fund.
Yep.
And so that's kind of the other end of the spectrum right now in today's climate. And then, for the local credit unions, community banks, sometimes they do that bridge to perm. So we don't need to refi. It could convert. With the debt funds, we are refining, and agency is available for
It is.
these
Okay.
projects as well. And we see at least a 50% increase in value over our cost basis after changing the use because of how fundamentally different hotels are valued versus multifamily. And so that allows us to do a cash out refinance and recap some of our equity to move into the next project.
And so there's never any exceptions with Fannie or Freddie and how they look at this. I mean, once you guys have converted it, the zoning's now classified as residential multifamily. The project's at a stability point, and they're good to go. Thumbs up, they're good to go. Is that
Yeah, I
fair?
mean, obviously it's got to fit their criteria in terms of
Yeah.
delinquency and occupancy and all of
Right, right,
those
right,
things. But
right.
if you meet
Yeah.
those criteria, we haven't run into any snags where they said, no, fundamentally this asset doesn't fit
Okay.
into our multifamily
That's
lending
great.
program.
That's great. No, fantastic. How about case study, like a recent case study of
Yeah.
one that you guys have gone from beginning to finish line on? Just to again to help those that are tuning in, paint the
Yeah.
picture. What it looks like. One of these
Mhm.
projects, maybe the market that you bought in, what what type of hotel it was, generally speaking, what type of renovations you've done to it, amenities you might have added, and then where's the project at today?
Yeah. I'll start with the first one that we did, just because
Okay.
it's a bit of a light bulb moment for us. And, after being, value add multifamily investors, we realized the power and the financial strategy behind this type of project. So the first project we ever did was in Tucson, Arizona. It was 175 units. Half of those units were operating as a hotel. The other half had already been converted into student housing because it was right down the street from the University of Arizona.
Hmm.
And so the business plan when we bought it in 2019 was to convert the second half into student housing. It's going to be great. Well, what happened in 2020? COVID. There were no students on campus. And so we delivered it in 2020 and we had to shift our marketing strategy. And so we shifted our marketing strategy to rent to, workforce, attainable housing folks. And it leased up like that. That property has stayed, 5% above the prevailing occupancy in the market, for the last few years. The average tenancy, I think, is 22 months there. And so it was a great project for us. We were in for just a little over $11 million, I think 11.2 all in. Sold it for 18.9, 19 months later. We've stayed actually involved in the project as a manager,
Hmm.
and that property is looking to be sold again. It's under contract right now to be sold for 24 million. And so I think that speaks to the staying power of the asset, even given all that's happened in the commercial real estate space with interest
Yeah.
rates. Just that, there really is value in these are multifamily assets when we're done with them, and investors and potential buyers look at them just that way.
Was the original? No, that's a great story. I appreciate that. Was the original plan after that first project was completed, assuming that COVID never happened, and assuming that you guys were successful with the student housing component, was that the future strategy, student housing versus that of attainable housing?
We were honestly just learning. I don't think we had committed to the strategy. We continued to do value add multifamily
Okay.
projects from 19 to 20 and 21. And then the market got too hot. And in 21 is when we sold that. And we wanted to see the realization of the exit before we really went toward hotel conversions.
Hmm.
And since the beginning of 22, we've been 100% focused on hotel conversions. And like you mentioned, we just started our 19th project.
Yeah, no, that's fantastic. Very exciting. So let's talk about the next 3 to 5 years. What's it look like for
Yeah.
your group?
Good question. We feel like this strategy is going to be available and attractive for the next 5 years. We're still underbuilding in this country. There's a lot of multifamily getting delivered this year, but there's very little getting started. I think right now we have in October, it was the widest gap between deliveries and
Mhm.
permits in history. I think it was like over almost 250,000 units was the delta. And so if you look out to 26 through 26, 27, 28, I think we're going to be in another supply crunch. And I don't think the affordability crisis is going away anytime soon with where mortgage rates are, with people kind of being locked up on the for sale side, and rental rates are still staying strong as well. And so we're really solving for the missing middle, for the folks that,
Yeah.
need high quality, clean housing. And there's also this natural distress that exists in hospitality that isn't going to go away. Like we were describing earlier, you're
Mhm.
describing those exits down the highway. And we see that playing out across the country. And so next 3 to 5 years, we're going to stay in our strategy and our niche. We're going to continue to build out our team. Our goal is to do about 10 to 15 projects per year. That's where we
Mhm.
feel like we can execute really well. And, just continue to grow from there. And, I feel very fortunate to be in the role that I am and working with the team that we have. And it's a really rare opportunity where, kind of doing good and solving this need can also be really good business as
Yeah.
well.
I love it. I love it. What's the
Yeah.
what's the opportunity down the road? if you guys decide to go down the path of maybe a roll up strategy, and then sell, hey, let's exit out.
Mhm.
Maybe it's 10 years down the road. Let's exit out of all of our assets. What is from today's perspective? What's the desirability standpoint from a larger institutional group? Or would they have an appetite for a portfolio of student or studio properties, or mostly studio properties, or would that might not be on the radar just yet?
It's on folks' radar. There are
Okay,
some funds out there that are building, they call them micro units from the
that's right.
ground
That's
up,
true.
right?
Fair enough. Yeah, fair
And
enough.
we've talked to some, impact funds, workforce housing funds that are very interested in a portfolio exit
Okay,
one day. So it's definitely something that's, it's a potential that exists out
awesome,
there for sure.
awesome. Ryan, what haven't I asked you? What haven't we talked about related to the strategy, related to Sage? Anything in between that you feel would be relevant for folks to know before we wrap this up for
Yeah.
today?
Maybe just the underlying fundamentals of how hospitality is valued versus multifamily. Maybe that would
Yeah,
be
I think that'd
something
be great.
interesting to touch on.
Absolutely.
So, they're both commercial properties. They're both, valued on cap rates. But maybe to simplify for folks who don't maybe aren't familiar with the cap rate math, a hotel is typically valued somewhere between 3 to 5 times the revenue that it generates.
Mhm.
Whereas a multifamily property will be 7 to 12 times the revenue that it generates. And the reason why investors are willing to pay a higher multiple for multifamily is, with a multifamily property, you're not changing bed sheets, you're not, keeping up with the furniture, you're not employing a big staff. And so your expenses are much lower and your occupancy is much higher. I think the
Mhm.
average hotel where I live in Washington State is only occupied 63% of the time,
Hmm.
whereas a multifamily property is, at least ours, 90, 95 plus percent occupied.
Mhm.
And so an investor is willing to, take on, willing to pay more, right, for that stability and the better cash flow. And, for us, we can kind of take advantage of this arbitrage that exists. And arbitrage maybe uh, limit or diminishes a bit of what we have to do on the development costs. The development side, there's a lot of hard development work that goes into it. But I think that's the underlying fundamentals of the strategy is that you can buy something, for 3 to 5 times and, it's going to trade for 7 to 12 times. And so that's where we see, at least that
Yeah.
50% increase over our original basis in the after renovated value that really powers our strategy and makes it so compelling.
Yeah. No, fantastic. One last question here, just as it relates to kind of identifying a good prospect. Does the year built have any relevance whatsoever?
It does. It does. There's certainly too old. We've bought everything from early 1900s through,
Oh,
like I
wow.
said, that we probably won't do again.
Yeah.
We've already sold that property, but typically we're looking in the 70s, 80s, 90s.
Okay.
That's when a lot of these hotels were built across the United States. Um,
Concrete block construction.
it could be stick
Okay.
built, yeah,
Okay. Okay.
but typically less
Fantastic.
than three stories.
Got it. Got it. Well,
Yeah.
fantastic. Well, Ryan, this has been a lot of fun, man. I appreciate you coming on here. For those that want to learn more about you and Sage and the different offerings that you have, where's the best place to track you down?
Yeah, you can go to our website, sageinvestment.com. You can book a meeting with me there. You can find me on LinkedIn under my name, or you can reach out via email, ryan@sageinvestment.group.
All righty. Well, good deal, Ryan. I appreciate you coming on, my friend. It's been a pleasure speaking with you.
Yeah, you as well. Thanks so much for the opportunity to chat today, Kevin.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.